So, how does a business really know if it made a profit last month? It sounds pretty simple, right? You just check the bank account. But hold on. What if you paid for a whole year's worth of insurance upfront? Or what if a client just paid you for a massive project you haven't even started yet? All of a sudden, that bank balance, it's not telling you the whole story, is it? Today, we are going to fix that.
All right, here's how we're going to do it. First, we'll tackle the whole cash versus reality problem. Then we'll talk about how to get a truer financial picture. After that, we'll dive into the nitty-gritty of adjusting the accounts. Then we'll see how accountants clean the slate for the next month. And finally, we'll get to the big reveal, the final polished financial portrait.
Okay, let's start with that core issue. It is so tempting to think about business finances like your own personal checking account. Money in, good, money out, bad. But in the world of business, the timing of when cash actually changes hands can be seriously misleading. And this brings us to two totally different ways of looking at money. The first, cash basis, is super simple. Cash comes in, you record revenue. Cash goes out, you record an expense. Easy. But the accrual basis, while a little more work, is way more accurate. It says, nope, we record revenue when we've actually earned it by doing the work. And, just as important, it says we record expenses in the period they helped us create that revenue, no matter when the cash actually moves.
And this, right here, this shows the difference perfectly. Let's say you pay $2,400 for a 2-year insurance policy. On the left, using the cash basis, it looks like you had this huge $2,400 expense all at once. It makes that 1 month look awful. But on the right, the accrual basis correctly says, hey, wait a minute, you're only using up $100 of that insurance each month. It matches the expense to the period it actually covers. See the difference? One is a distorted mess, the other is the truth.
So that's the million-dollar question, isn't it? If that simple cash method gives us this blurry, out-of-focus snapshot, how in the world do we get that sharp, accurate portrait that accrual accounting is promising us? Well, the answer is a set of principles that basically act like a professional photo editor for our financial statements. This is what accrual accounting is all about, and it's all built on two simple but really powerful golden rules. Okay, so this is absolutely crucial. First, the revenue recognition principle. It basically says you only get to count your money when you've done the work, not just because a client sent you a check. Second, you have the expense recognition principle, which most people call the matching principle. And this is key. It says you have to record your costs in the very same period as the revenues they helped you earn. That matching is what gives you an honest, true income statement. All right, so we've got the rules, but how do we actually put them into practice? This is where we get our hands dirty with something called adjusting entries, which are done at the very end of every single accounting period.
Now, look, this can seem a little complicated because there are technically 4 types of these adjustments. But to make it way easier, you can just think of them as 2 simple pairs. And it all comes down to one simple question. Which came first, the cash or the actual business activity?
Our first category is called deferrals. And that word defer just means to postpone. This is what we do when the cash moves before the real activity happens. We have to hit the pause button and defer recognizing an expense or a revenue. The cash came first, the work comes later. This slide is great because it shows the 2 sides of the deferral coin. On the left, you've got a prepaid expense. That's our insurance example. We paid cash up front, which creates an asset, a resource we now own. Then, as time passes, we make an adjustment to show that we've used up a piece of that asset, and that piece becomes an expense. Now on the right, you've got unearned revenue. This is when a client pays us before we do the work. That cash creates a liability, basically an IOU. We owe them the work. As we do the work, we adjust our books to turn that liability into revenue we finally actually earned. And here it is with real numbers. We pay for that $2,400 insurance policy, boom, it's an asset. At the end of the month, we adjust our books to say, okay, $100 of that got used up, it's an expense now. Or a client pays us $3,000 in advance. That's a liability called unearned revenue. After 5 days go by, we adjust things to recognize that, hey, we've earned $250 of that money. So our second category is the exact mirror image. Accruals. This is when the business activity happens first. We've incurred a cost or we've earned some revenue, but no cash is moved yet. We have to accrue or build up these unrecorded things on our books so they don't get forgotten. And this slide shows you the 2 types of accruals. On the left, an accrued expense. Just think about employee salaries. Your team has worked the last few days of the month, so you've definitely incurred that expense, but payday isn't until next month.
so you have to record the expense and a liability right now to show you owe them that money. Then on the right, you have accrued revenue. This happens when you've done the work for a client, but you just haven't sent the bill yet. You've earned that money, so you record the revenue along with an asset called accounts receivable, which is just a formal way of saying the client now owes you cash.
Let's put some numbers to that. If an employee works the last 3 days of the month, but doesn't get paid till next month, we still have to record a $210 salary expense for this period. Same goes for revenue. If we've completed $1,800 worth of a project, but the invoice isn't going out till later, we accrue that revenue right now because we earned it right now.
Okay, phew. We've made all our adjustments. The picture for this month is finally accurate. But before we can roll into the next month, we've got to do one last cleanup. It's kind of like wiping a whiteboard totally clean so you can start fresh. So here's the trick. You have to understand that not all accounts are the same. Some are temporary, things like revenues, expenses, and owner withdrawals. They only track activity for one single period, so at the end of the month, we have to zero them out. But other accounts are permanent, like assets, liabilities, and owner's capital. They carry their balances forward. I mean, think about it. Your cash balance doesn't just reset to zero every month, right? Of course not. So this closing process happens in 4 quick steps. First, we dump all our revenue account balances into this temporary little holding pen called income summary. Second, we do the exact same thing with all our expense accounts, dump them into that same income summary account. The balance that's left over in income summary, well, that's our net income for the month. Third, we take that net income and transfer it into the owner's capital account, which is a permanent account. And last, we close out any money the owner took out by reducing that same capital account. And just like that, all our temporary accounts are back to zero, totally ready for the next period.
So, after all that work, adjusting for all those timing differences and then closing out the books, what do we actually get? What's the final result? This is the whole payoff. All of those little adjustments we made, they all flow through the system to create this perfectly interconnected set of financial statements. The net income we calculated flows to the next statement, which then flows to the balance sheet, which is now perfectly, beautifully in balance. It's a complete, accurate, and totally reliable picture of the business.
And the ultimate final portrait is something we call a classified balance sheet. And don't let the word classified scare you. It literally just means organized. It takes that super accurate snapshot and arranges it in a way that's incredibly easy to read and understand by grouping things into short-term and long-term buckets.
So why is that so useful? Well, it gives you an instant read on the company's financial health. By comparing your short-term assets to your short-term liabilities, for instance, you can see right away if the company has enough cash on hand to pay its bills for the next year. That's a huge deal for anyone thinking of investing or lending money to the business. Separating out those immediate items from the long-term stuff like equipment or a 10-year loan, well, it just gives us incredibly valuable insight.
And it's really important to remember that all the stuff we've talked about today isn't some one-time fix. Adjusting the accounts and closing the books, these are critical steps in the never-ending cyclical process of accounting. It happens over and over again, every single period, to keep that financial picture totally clear and up to date.
So, we did it. We went from a blurry, confusing cash-based snapshot to a sharp, professionally developed portrait of a company's finances. And the entire point of this whole process is to get that accurate picture. Which leads us to the most important question of all. Now that you can see it clearly, what story is that picture telling you about the business?